Section 5.1 to 5.3 Fundamental Analysis, 5.1 Industry Analysis. When evaluating industry trends, growth prospects, and the competitive landscape, there are several factors to consider. Here are some key areas to focus on: market size and growth. Assess the overall size of the industry and its potential for growth. Look for data on historical growth rates, projected growth rates, and factors driving or inhibiting industry expansion. Consider demographic trends, technological advancements, regulatory changes, and other factors that can impact industry growth. Competitive analysis. Evaluate the competitive landscape within the industry. Identify major competitors, their market shares, and their strengths and weaknesses. Analyze the barriers to entry, such as high capital requirements or intellectual property protection, and assess the threat of new entrants or substitutes. Consider competitive strategies, differentiation factors, and any disruptive forces that could reshape the industry. Industry dynamics. Understand the dynamics of the industry, including supply and demand factors, pricing trends, and industry cycles. Analyze industry structure, concentration, and potential consolidation. Identify key industry players, industry associations, and regulatory bodies that influence the industry's development. Technological advancements. Examine the impact of technology on the industry. Evaluate how emerging technologies are changing business models, product offerings, and customer expectations. Consider the potential for disruption and the ability of industry participants to adapt to technological changes. Customer behavior and trends. Study customer behavior and preferences within the industry. Identify emerging consumer trends, shifting demographics, and changes in purchasing patterns. Consider how customer needs and preferences are evolving and how industry players are responding to these changes. Regulatory and legal environment. Assess the regulatory and legal framework governing the industry. Stay updated on changes in regulations, compliance requirements, and potential risks or opportunities arising from regulatory shifts. Understand the impact of government policies, trade agreements, and geopolitical factors on the industry. Sustainability and environmental factors. Consider the industry's environmental impact and the growing importance of sustainability. Evaluate how environmental regulations, consumer preferences for sustainable products, and corporate social responsibility initiatives are shaping the industry. Assess potential risks and opportunities associated with sustainability trends. Analyst reports and industry research. Consult industry research reports, market studies, and analyst reports from reputable sources. These resources provide valuable insights into industry trends, growth prospects, and competitive dynamics. It's important to conduct a thorough analysis of these factors to understand the industry's attractiveness, potential risks, and growth opportunities. This analysis can help inform investment decisions, strategic planning, and risk management strategies. Porter's 5 Forces Framework and SWOT analysis are two widely used tools for assessing a company's competitive position and analyzing its external and internal factors. Here's an overview of each framework. Porter's 5 Forces. Porter's 5 Forces is a framework developed by Michael Porter that analyzes the competitive forces within an industry. It helps evaluate the attractiveness of an industry and understand the potential threats and opportunities facing a company. The 5 forces are: A. Threat of new entrants. Assess the ease or difficulty for new companies to enter the industry. Factors such as barriers to entry, capital requirements, economies of scale, and regulatory barriers influence the threat of new entrants. B. Bargaining power of suppliers. Evaluate the power that suppliers hold over the industry. Consider factors such as the availability of substitute inputs, concentration of suppliers, switching costs, and the importance of supplier inputs to the industry. C. Bargaining power of buyers. Evaluate the power that buyers or customers hold over the industry. Factors such as buyer concentration, switching costs, availability of substitute products, and price sensitivity impact the bargaining power of buyers. D. Threat of substitute products or services. Assess the likelihood of customers switching to alternative products or services. Consider factors such as the availability of substitutes, price-performance trade-offs, and switching costs. E. Intensity of competitive rivalry. Analyze the level of competition within the industry. Factors such as the number of competitors, market growth rate, differentiation, and exit barriers impact the intensity of competitive rivalry. SWOT analysis. SWOT analysis is a framework used to evaluate a company's internal strengths and weaknesses and its external opportunities and threats. It provides a comprehensive overview of the company's current position and helps identify areas for improvement and potential risks. The analysis involves the following components. Strengths. Identify the internal strengths of the company, such as unique capabilities, competitive advantages, strong brand reputation, talented workforce, or efficient operations. B. Weaknesses. Identify the internal weaknesses or areas of improvement for the company, such as lack of diversification, high costs, outdated technology, weak brand image, or limited distribution channels. C. Opportunities. Identify external opportunities in the market that the company can capitalize on, such as emerging market trends, new customer segments, technological advancements, or favorable regulatory changes. D. Threats. Identify external threats that can potentially impact the company's performance, such as intense competition, changing consumer preferences, economic downturns, regulatory challenges, or disruptive technologies. SWOT analysis helps in strategic planning, decision-making, and understanding the company's overall position in relation to its external environment. It provides insights into leveraging strengths, addressing weaknesses, exploiting opportunities, and mitigating threats. Both Porter's 5 forces and SWOT analysis are valuable frameworks that complement each other in assessing a company's competitive position. They provide a holistic view of the company's external and internal factors, enabling better-informed strategic decisions. Industry dynamics have a significant impact on company performance. Understanding and effectively responding to industry dynamics is crucial for a company to maintain a competitive advantage and achieve sustainable success. Here are some key ways in which industry dynamics can influence company performance. Competitive landscape. Industry dynamics shape the level of competition within the industry. Highly competitive industries may experience price wars, reduced profit margins, and increased pressure on companies to differentiate themselves. Companies must develop effective strategies to position themselves competitively and gain market share. Market growth and demand. Industry dynamics impact the overall market growth rate and demand for products or services. Companies operating in fast-growing industries can experience higher sales and profit potential. Conversely, companies in slow-growing or declining industries may face challenges in generating growth and need to explore new market opportunities or diversify their product/service offerings. Technological advancements. Industry dynamics often involve technological advancements that can disrupt traditional business models. Companies that embrace and adapt to technological changes can gain a competitive edge, while those that fail to innovate may be left behind. Staying aware of emerging technologies and their potential impact on the industry is crucial for long-term success. Regulatory environment. Industry dynamics are influenced by the regulatory environment. Changes in regulations and government policies can create opportunities or pose challenges for companies. Adapting to regulatory changes and ensuring compliance can impact a company's operations, costs, and market positioning. Customer behavior and preferences. Industry dynamics are shaped by evolving customer behavior and preferences. Companies must stay attuned to changing customer needs, demands, and purchasing patterns. Adapting products, services, and marketing strategies to meet customer expectations is essential for maintaining competitiveness. Supply chain management. Industry dynamics affect the efficiency and effectiveness of supply chain management. Companies need to consider factors such as sourcing, logistics, inventory management, and supplier relationships to optimize their supply chain operations. Managing costs, ensuring quality, and minimizing lead times are critical in meeting customer demands and maintaining profitability. Industry collaboration and partnerships. Industry dynamics may necessitate collaboration and partnerships among companies. Joint ventures, strategic alliances, or partnerships can provide access to complementary resources, technologies, or markets. Collaborative efforts can enhance a company's competitiveness and create opportunities for growth. Economic factors. Industry dynamics are influenced by broader economic factors, including interest rates, inflation, GDP growth, and consumer spending. Economic fluctuations can impact customer purchasing power, industry investment levels, and overall market conditions. Companies must assess and respond to economic trends to optimize their performance. understanding industry dynamics is essential for effective strategic planning, identifying growth opportunities, mitigating risks, and making informed business decisions. Regular monitoring of industry trends, competitor analysis, and engagement with industry networks and associations can provide valuable insights into the changing dynamics and help companies navigate challenges and leverage opportunities. 5.2 Management Assessment. Evaluating the quality and competence of company management is a crucial aspect of assessing a company's overall performance and long-term prospects. Strong and capable management can effectively navigate challenges, drive growth, and create value for shareholders. Here are some key factors to consider when evaluating management: track record and experience. Assess the management team's track record and experience in successfully leading the company and achieving strategic objectives. Look for evidence of their ability to deliver consistent financial performance, execute on growth initiatives, and navigate industry-specific challenges. Consider their tenure in leadership positions and their experience in the industry. Strategic vision and leadership. Evaluate the management team's strategic vision and their ability to set clear goals and objectives for the company. Consider their leadership style, communication skills, and ability to inspire and motivate employees. Assess their willingness to take calculated risks and their ability to adapt to changing market conditions. Execution capability. Assess the management team's ability to execute strategies and deliver results. Look for evidence of effective decision-making, strong operational performance, and efficient resource allocation. Evaluate their ability to drive innovation, manage costs, and adapt to technological advancements. Corporate governance. Evaluate the company's corporate governance practices, including the board composition, independence, and expertise of directors. Consider the existence of robust governance structures, such as board committees, and the transparency of financial reporting and disclosure practices. Assess the alignment of management's interests with those of shareholders. Succession planning. Assess the management team's approach to succession planning. Consider whether there is a clear plan in place for leadership transitions and whether the company has a strong bench of talented executives. Evaluate the company's ability to retain and attract top talent, industry knowledge and relationships. Evaluate the management team's knowledge of the industry in which the company operates. Consider their understanding of industry trends, competitive dynamics, and regulatory environment. Assess their relationships with key stakeholders, including customers, suppliers, and industry partners. Integrity and ethical conduct. Assess the management team's commitment to ethical conduct and integrity. Look for evidence of transparent and ethical decision-making, adherence to legal and regulatory requirements, and a culture of integrity throughout the organization. Consider any history of legal or ethical issues related to the management team. Communication and investor relations. Evaluate the management team's communication skills and their ability to effectively engage with shareholders and the broader investor community. Look for timely and transparent communication of company performance, strategies, and risks. Consider their responsiveness to investor inquiries and concerns. It's important to consider both quantitative and qualitative factors when evaluating management. Reviewing financial performance, analyzing industry-specific challenges, and conducting interviews or meetings with management can provide valuable insights into their capabilities, character, and strategic direction. Additionally, analyzing peer reviews, industry recognition, and employee satisfaction can offer a broader perspective on management's competence and the overall culture of the organization. Analyzing management's track record, corporate governance, and strategic decisions is essential for evaluating the effectiveness and competence of a company's leadership. Here are key aspects to consider when conducting this analysis. Track record of performance. Evaluate the management team's track record of financial performance, including revenue growth, profitability, and return on investment. Look for consistent and improving performance over time. Assess whether the management team has been successful in meeting or exceeding their stated goals and targets. Long-term value creation. Assess the management team's ability to create long-term value for shareholders. Look at the company's historical stock price performance and compare it to industry peers or relevant benchmarks. Evaluate whether management has been able to generate sustainable growth and shareholder returns. Strategic decision-making. Analyze the management team's strategic decisions and their impact on the company's performance. Evaluate the rationale behind major initiatives, such as mergers and acquisitions, divestitures, new product launches, or international expansion. Assess the effectiveness of these decisions in terms of market positioning, competitive advantage, and financial outcomes. Corporate governance practices. Evaluate the company's corporate governance framework and practices. Consider the independence and expertise of the board of directors, the presence of board committees, such as audit, compensation, and governance committees, and the effectiveness of the company's risk management and internal control systems. Assess the company's compliance with relevant corporate governance guidelines and regulations. Alignment of management and shareholder interests. Assess the alignment of management's interests with those of shareholders. Consider the extent to which management holds shares or stock options in the company, as well as any performance-based compensation plans tied to specific financial or operational targets. Evaluate the presence of any potential conflicts of interest between management and shareholders. Transparency and disclosure. Evaluate the company's transparency and disclosure practices. Assess the quality and timeliness of financial reporting, including the clarity of financial statements, footnotes, and management discussions and analysis. Consider the company's level of disclosure regarding risks, uncertainties, and material events that may impact its performance. Stakeholder relationships. Analyze management's relationships with key stakeholders, such as customers, suppliers, employees, and the broader community. Assess their ability to build and maintain strong relationships that contribute to the company's success. Consider the company's reputation and the management team's efforts to address social and environmental concerns, adaptability and innovation. Assess management's ability to adapt to changing market conditions and industry trends. Consider their track record in identifying and capitalizing on new opportunities. Evaluate the company's investment in research and development, innovation initiatives, and its ability to stay ahead of technological advancements. By analyzing management's track record, corporate governance practices, and strategic decisions, investors can gain insights into the competence, integrity, and effectiveness of the company's leadership. It is important to consider both quantitative and qualitative factors and to gather information from a variety of sources, including financial statements, annual reports, regulatory filings, and industry news. Assessing the alignment of management's interests with shareholders is an important aspect of evaluating the effectiveness and integrity of a company's leadership. When management's interests are aligned with those of shareholders, it typically indicates that management is focused on creating long-term shareholder value rather than pursuing self-serving or short-term objectives. Here are some key factors to consider when assessing this alignment. Share ownership. Evaluate the extent to which management holds shares in the company. Significant ownership by management demonstrates a direct alignment of their interests with shareholders, as they stand to benefit from increases in the company's stock price. Look for long-term holdings rather than short-term trading activity. Stock options and incentive plans. Assess whether management's compensation includes stock options or equity-based incentives. Stock options provide management with the opportunity to profit if the company's stock price increases over time. This incentivizes them to make decisions that will enhance shareholder value. Performance-based compensation. Examine the structure of management's compensation packages and assess the extent to which they are tied to specific financial or operational performance metrics. Performance-based compensation aligns management's interests with shareholders by linking their rewards to the company's success. Look for performance measures that are challenging but achievable and promote sustainable growth. Long-term incentives. Evaluate the presence of long-term incentives that encourage management to focus on the company's sustained performance and growth. This could include restricted stock units, performance shares, or deferred compensation plans. Such incentives discourage short-termism and encourage management to make decisions that benefit shareholders over the long term. Disclosure and transparency. Review the company's disclosures regarding management's compensation and share ownership. Transparent and comprehensive reporting allows shareholders to assess the alignment of management's interests. Look for clear explanations of how management's interests are tied to the company's performance and how their compensation is determined. Insider trading activity. Monitor insider trading activity by management to gauge their confidence in the company's prospects. Significant purchases of company shares by management indicate a belief in future growth. While sales of shares without a compelling reason may raise concerns about their confidence in the company's performance, voting and shareholder engagement, assess management's approach to voting and shareholder engagement. Look for evidence of management actively seeking input from shareholders and responding to their concerns. Transparent and fair voting practices demonstrate a commitment to shareholder rights and an interest in representing their interests. Communication with shareholders. Evaluate the quality and frequency of communication between management and shareholders. Open and transparent communication, such as regular updates, investor presentations, and QA sessions, can indicate a genuine interest in keeping shareholders informed and engaged. By considering these factors, investors can gain insights into the alignment of management's interests with shareholders. It is important to review information from various sources, such as proxy statements, annual reports, regulatory filings, and investor presentations, to assess the degree to which management is focused on creating long-term value for shareholders. 5.3 Risk Analysis. Identifying and assessing company-specific risks is crucial for evaluating the overall risk profile of a company and making informed investment decisions. While industry and market risks are important to consider, understanding the specific risks that are unique to a company can provide deeper insights into its potential challenges and vulnerabilities. Here are some steps to identify and assess company-specific risks. Review annual reports and disclosures. Start by thoroughly reviewing the company's annual reports, including the Management Discussion and Analysis (MDA) section. These reports often provide detailed information about the company's operations, risks, and uncertainties. Pay attention to the specific risks highlighted by the company and any potential impacts they may have on the business. Analyze financial statements. Conduct a comprehensive analysis of the company's financial statements, including the balance sheet, income statement, and cash flow statement. Look for any financial risks that may be evident, such as high debt levels, liquidity concerns, or declining profitability. Assess the potential impact of these risks on the company's financial health and stability. Evaluate industry and market risks. While focusing on company-specific risks, it's important to also consider the broader industry and market risks that may impact the company. Assess factors such as competition, regulatory changes, technological advancements, and economic conditions that could pose risks to the company's operations and performance. Conduct SWOT analysis. Perform a SWOT, strengths, weaknesses, opportunities, threats, analysis to identify and assess the company's internal strengths and weaknesses, as well as external opportunities and threats. This analysis helps identify company-specific risks by highlighting areas where the company may be particularly vulnerable or exposed to potential challenges. Research industry and competitive landscape. Gain a deep understanding of the industry in which the company operates and the competitive landscape it faces. Identify any specific risks associated with the industry, such as technological disruption, changing consumer preferences, or regulatory shifts. Assess how the company is positioned within the industry and its ability to navigate these risks. Monitor key operational risks. Identify and assess the key operational risks that the company may face. This could include risks related to supply chain management, product quality, intellectual property, cybersecurity, or environmental and social responsibility. Evaluate the company's risk management practices and mitigation strategies in place to address these risks. Consider management and governance risks. Assess the potential risks associated with company management and governance practices. Evaluate the competence and integrity of the management team, the effectiveness of the board of directors, and the company's overall corporate governance framework. Identify any governance-related risks that could impact the company's performance or reputation. Stay informed and seek expert opinions. Stay up to date with news, industry reports, and expert opinions related to the company. Monitor any significant developments, such as legal disputes, regulatory investigations, or leadership changes, that could impact the company's risk profile. Consider engaging with industry analysts or consulting with financial advisors to gain additional insights into the specific risks faced by the company. Remember that risk assessment should be an ongoing process as risks can evolve over time. Regularly monitor and reassess company-specific risks to ensure that your investment decisions are based on the most up-to-date information. Macroeconomic risks. Macroeconomic risks refer to risks stemming from the overall economic environment in which a company operates. These risks can have a broad impact on businesses across various industries. Some examples of macroeconomic risks include economic downturn. A general economic slowdown or recession can reduce consumer spending, affect business investment, and lead to declining demand for products and services. Inflation and deflation. Rapid increases in prices, inflation, or sustained decreases in prices, deflation, can impact a company's profitability, input costs, and consumer purchasing power. Interest rate fluctuations. Changes in interest rates can affect borrowing costs. Capital investments and consumer spending patterns, which can impact a company's profitability and financial health. Currency exchange rate volatility. Companies engaged in international trade or with significant foreign operations may face risks associated with currency exchange rate fluctuations, which can impact their revenue and cost structures. Regulatory risks. Regulatory risks refer to risks arising from changes in laws, regulations, and government policies that directly affect a company's operations or industry. These risks can include compliance and legal risks. Companies must comply with various laws and regulations related to areas such as labor, environmental protection, data privacy, and product safety. Failure to comply with these regulations can result in fines, legal actions, or reputational damage. Government policy changes. Changes in government policies, such as tax laws, trade regulations, or industry-specific regulations, can impact a company's operations. Profitability and competitive position. Regulatory approvals and licensing. Certain industries, such as pharmaceuticals or energy, require regulatory approvals or licenses to operate. Delays or denials in obtaining these approvals can hinder a company's ability to conduct business. Competitive risks. Competitive risks refer to risks associated with competition within the industry in which a company operates. These risks can include intense competition. Increased competition from existing competitors or new entrants can impact a company's market share, pricing power, and profitability. Technological disruption. Rapid advancements in technology can disrupt traditional business models and render products or services obsolete. Companies must continuously innovate and adapt to stay competitive. Supplier or customer concentration. Dependence on a small number of suppliers or customers can create risks, as changes in their business strategies or financial stability can have a significant impact on the company. Pricing pressures. Price wars or aggressive pricing strategies by competitors can erode a company's profit margins and market share. It's important for investors and businesses to carefully consider these macroeconomic, regulatory, and competitive risks when analyzing and assessing the overall risk profile of a company. Understanding these risks can help inform investment decisions, strategic planning, and risk mitigation efforts. Incorporating risk analysis into the investment decision-making process is crucial for making informed and prudent investment decisions. Here are some steps to incorporate risk analysis effectively. Identify and assess risks. Begin by identifying and assessing the various types of risks associated with the investment. This includes company-specific risks, macroeconomic risks, regulatory risks, and competitive risks. Conduct a comprehensive risk assessment to understand the potential impact of these risks on the investment. Quantify risks. Quantify the identified risks to the extent possible. Assign probabilities to the occurrence of each risk and estimate the potential magnitude of their impact. This helps in prioritizing and comparing the risks to better understand their significance. Diversify investments. Diversification is a key risk management strategy. Allocate your investment across different asset classes, industries, and geographies to reduce the impact of specific risks. Diversification can help mitigate the effects of company-specific risks and industry-specific risks. Consider risk-return trade-off. Evaluate the risk-return trade-off of the investment. Higher-risk investments typically offer the potential for higher returns, but they also carry greater uncertainties. Assess whether the potential returns justify the level of risk involved and determine your risk tolerance. Use risk metrics and models. Utilize risk metrics and models to evaluate the risk profile of the investment. Measures such as standard deviation, beta, value at risk, VAR, and expected shortfall, ES, can provide insights into the potential downside risk and volatility of the investment. Stress testing and sensitivity analysis. Conduct stress testing and sensitivity analysis to evaluate the impact of adverse scenarios on the investment. Assess how the investment performs under different market conditions, economic downturns, or changes in key variables. This analysis helps in understanding the resilience and potential vulnerabilities of the investment. Monitor and update risk analysis. Risk analysis should be an ongoing process. Continuously monitor the investment and its associated risks. Stay informed about relevant market trends, industry developments, and regulatory changes that may impact the investment. Regularly update and reassess your risk analysis to reflect new information or changes in circumstances. Seek expert advice. If needed, consult with financial advisors or investment professionals who have expertise in risk analysis. They can provide valuable insights and help you navigate the complexities of risk assessment and management. Maintain a long-term perspective. Incorporating risk analysis into the investment decision-making process requires a long-term perspective. Understand that risks are inherent in investing and that short-term fluctuations should not drive investment decisions. Evaluate the investment's potential over the long term, considering both risks and potential rewards. By incorporating risk analysis into the investment decision-making process, you can make more informed investment choices, align your investments with your risk tolerance, and potentially enhance your overall portfolio performance.